Good morning, everybody. Thank you very much for coming. Welcome to the Bank of England's Financial Stability Report press conference. On my far right is John Cunliffe, the Deputy Governor for Financial Stability. On my left is Sam Woods, the Deputy Governor for Prudential Regulation. And on my immediate right is the Governor, Mark Carney.
Thank you, Gareth. Good morning, everyone. The FPC's job is to ensure that UK households and businesses can rely on their financial system through thick and thin. And to that end, today's Financial Stability Report and the accompanying stress tests address a wide range of risks to UK financial stability. And they will catalyze action to keep the system well prepared for potential vulnerabilities in the short, medium, and long terms. In particular, this year's cyclical stress test incorporates risks that could arise from global debt vulnerabilities and elevated asset prices, from the UK's large current account deficit, and from the rapid buildup of consumer credit. Despite the severity of the test, for the first time since the bank began stress testing in 2014, no bank needs to strengthen its capital position as a result. Informed by the stress tests and our own risk analysis, the FPC also judges that the banking system can continue to support the real economy, even in the unlikely event of a disorderly Brexit. At the same time, the FPC has identified a series of actions that public authorities and private financial institutions need to take to mitigate some major cross-cutting financial stability risks associated with leaving the European Union. The bank's first exploratory scenario assesses major UK banks' strategic responses to longer-term risks to banks from an extended low-growth, low-interest rate environment and increasing competitive pressures enabled by new financial technologies. And those results suggest that banks may need to give more thought to such strategic challenges. So let me turn to the annual cyclical stress test. This year's test results show that the banking system would be well placed to provide credit to households and businesses, even during simultaneous deep recessions in the UK and global economies, large falls in asset prices, and a very large stressed misconduct cost. The economic scenario in the 2017 stress test is more severe than the deep recession that followed the global financial crisis. Vulnerabilities in the global economy trigger a 2.4% fall in world GDP and a 4.7% fall in UK GDP. In the stress scenario, there is a sudden reduction in investor appetite for UK assets, and sterling falls sharply as vulnerabilities associated with the UK's large current account deficit crystallize. Bank rate rises sharply to 4%, and unemployment more than doubles to 9.5%. UK residential and commercial real estate prices fall by 33% and 40%, respectively. In line with the bank's concerns over consumer credit, the stress test incorporated a severe credit impairment rate of 20% over the 3 years across the banking system as a whole. The resulting sector-wide loss of £30 billion is £10 billion higher than implied by the 2016 test. The stress leads to total losses for UK banks of around £50 billion during the first 2 years, losses that would have wiped out the entire equity capital base of the banking system 10 years ago. Today's such losses can be fully absorbed within the capital buffers that banks must carry on top of their minimum requirements. This means that even after a severe stress, major UK banks would still have a Tier 1 capital base of over £275 billion, or more than 10% of risk-weighted assets, in order to support lending to the real economy. This resilience reflects the fact that major UK banks have tripled their aggregate Tier 1 capital ratio over the course of the past decade to 16.7% today. Informed by the stress test results for losses on UK exposures, the FPC's judgment is that this domestic risk environment, apart from Brexit, is standard. And consistent with the FPC's guidance in June, the FPC is raising the UK countercyclical buffer rate from 0.5% to 1%, with binding effect from 28 November 2018. In addition, as previously announced, capital buffers for individual banks will be reviewed by the PRC in January. These will reflect firm-specific results of the stress test, including the judgments made by the FPC and PRC in September. These buffers can be drawn on as necessary during a downturn to allow banks to support the real economy. Turning to Brexit, there are a range of possible outcomes for the future UK-EU relationship. Consistent with its remit, the FPC is focused on those scenarios that, even if they are the least likely to occur, could have the greatest impact on UK financial stability. These include scenarios where there is no agreement or no transition period in place at the time of exit. The 2017 stress test encompasses the many possible combinations of macroeconomic risks and associated losses to banks that could arise in such an event. As a consequence, the FPC judges that, given their current levels of resilience, UK banks could continue to support the real economy even in the event of a disorderly exit from the European Union. That said, in the extreme event in which the UK faced a disorderly Brexit, combined with a severe global recession and stressed misconduct costs, losses to the banking system would likely be more severe than in this year's annual test. In this case, where a series of highly unfortunate events happened simultaneously, capital buffers would need to be drawn down substantially more than in the test, and as a result, banks would likely need to restrict lending to the real economy, worsening macroeconomic outcomes. The FPC will therefore reconsider the adequacy of the 1% UK countercyclical capital buffer rate during the first half of next year in light of the evolution of the overall risk environment. Of course, Brexit could affect the financial system more broadly. Consistent with the bank's statutory responsibilities, the FPC is publishing a checklist of the steps that would promote financial stability in the United Kingdom in the event of a no-deal outcome. This checklist has 4 important elements. First, ensuring that a UK legal and regulatory framework for financial services is in place at the point of leaving the EU. The government plans to achieve this through the EU withdrawal bill and related secondary legislation. Second, recognizing that it will be difficult ahead of March 2019 for all financial institutions to have completed all the necessary steps to avoid disruption in some financial services, timely agreement on an implementation is necessary to significantly reduce such risks, which could materially disrupt the provision of financial services in Europe and the UK. Third, preserving the continuity of existing cross-border insurance and derivative contracts is necessary. Domestic legislation will be required to achieve this in both cases, and for derivatives, corresponding EU legislation will also be necessary. Otherwise, 6 million UK insurance policyholders with £20 billion of insurance coverage and 30 million EU policyholders with £40 billion of insurance coverage could be left without effective cover, and around 26 trillion of derivative contracts could also be affected. Her Majesty's Treasury is considering all options for mitigating these risks. Fourth, deciding on the authorizations of EEA banks that currently operate in the UK as branches. Conditions for authorization, particularly for systemic firms, will depend on the degree of cooperation between regulatory authorities in the UK and EU. As previously indicated, the PRA plans to set out its approach before the end of this year. Irrespective of the particular form of the UK's future relationship with the EU, and consistent with its statutory responsibilities, the FPC will remain committed to the implementation of robust prudential standards. This will require maintaining a level of resilience that is at least as great as that currently planned, which itself exceeds that required by international baseline standards. Over the longer term, the resilience of UK banks could be tested by gradual but significant changes to business fundamentals. So for the first time, the FPC and the PRA have examined the strategic responses of major UK banks to an extended low-growth, low-interest rate environment, combined with increasing competitive pressures from retail banking from increased use of financial technologies. And to be clear, FinTech is creating opportunities for businesses and consumers, and it has the potential to increase the resilience and competitiveness of the UK financial system as a whole. In the process, however, it could also have profound consequences for the business models of incumbent banks. This exploratory exercise is designed to encourage banks to consider such strategic challenges, and it will influence future work by banks and regulators about longer-term issues, rather than informing the FPC and the PRC about the immediate capital adequacy of participants. In the test, major UK banks believed that they could, by reducing costs, adapt to such an environment without major changes to strategy or by taking on more risk. The Bank of England has identified clear risks to these projections. First, competitive pressures enabled by fintech may cause greater and faster disruption to banks' business models than they currently expect. Secondly, the cost of maintaining and acquiring customers in a more competitive environment could reduce the scope for cost reductions or result in greater loss of market share. And third, the future cost of equity for banks could be higher than the 8% level that banks expected in this scenario, either because of higher economic uncertainty or greater perceived downside risks. To conclude, the FPC is taking action to address the major risks to UK financial stability. Given the tripling of their capital base and marked improvement in their funding profiles over the past decade, the UK banking system is now resilient to the potential risks associated with a disorderly Brexit. In addition, the FPC has identified the key actions to mitigate the impact of other major cross-cutting issues associated with Brexit that could create risks elsewhere in the financial sector. And thirdly, on top of its existing measures to guard against a significant buildup of debt, the FPC has taken action to ensure that banks are capitalized against pockets of risk that have been building elsewhere in the economy, such as in consumer credit. As a consequence of these and other actions, the people of the United Kingdom can remain confident they can access the financial services they need to seize the opportunities ahead. And with that, Sam, John, and I would be pleased to take your questions.
Okay, so now we'll go to questions. Please wait for the mics. And as always, can you give your name and the organisation you represent? And please keep to just one question each the first time around, please. Now we'll start with Joel and Caroline at the back there afterwards.
Good morning. Joel Hills from ITV News. Governor, to avoid the disruption you speak of, how long does a transition period need to be, and how soon do we need agreement?
Well, we have said from the outset that for financial institutions, a transition period of between 18 and 24 months would be the minimum necessary. That's what we said in July of 2016. Subsequent to that, we have been reviewing the contingency plans, the transition plans of all the financial institutions based here, both outbound and inbound, if you will. And I would say that the 24 months period remains a good estimate given where we are today. The timing of achieving a transition agreement, the sooner the better. I won't put an end date on it. Any transition period will be valuable. There's some, we've signaled, I think, actually not signaled, we signaled back in June of this year some major risks around derivatives, around insurance, around data, around other aspects of the financial system, these cross-cutting issues, and we've done a lot of work since then and provided considerable detail around those risks, and also some potential mitigating actions. But much of this would be made considerably easier by a material transition period. And I think that is increasingly appreciated on both sides of the channel.
Caroline.
Caroline Binham from the Financial Times. Governor, you said that a disorderly Brexit would be an unlikely event. How did you come to the determination that it would be unlikely?
Well, on the basis of several things. I think first that the stated intentions of the UK government and the President of the European Council other European leaders is to come to an agreement. The disorderly Brexit, in the words of President Juncker, President Tusk, is in nobody's interests, and all the parties are working towards a form of agreement, both on end state and ideally on transition. What we have to do, and you appreciate this, I know, is look at the tail events. What can go wrong, regardless of probability? And so that's where we have focused our attention. And our responsibility is to make sure that the core of the system, the major UK banks and building societies, are in a position to have sufficient resilience both in capital and funding and business model to be able to withstand the shock of a disorderly Brexit. Then related to that is to identify broader issues in the financial sector that in some cases we can't solve and the institutions themselves can't solve. No private UK institution, in our view, can solve the issues around derivative contracts. There's just not enough time between now and March 2019 to novate tens and tens of thousands of derivative pairs between UK and EU institutions. For that reason, there is a need for, in our view, secondary legislation on contract continuity, both in the UK and in the EU. And by surfacing this issue back in the spring, providing more detail, working with European colleagues, working with the Treasury, we're looking to catalyze that action. And I think these issues are increasingly appreciated. So the relative probability, to some extent, Caroline, from an FPC perspective, we don't worry about being too precise about it because we focus on the tails. This is the clear tail event. And so what we want to do is get out, our job is to identify the key issues and catalyze the right actions.
Okay, David, here, just next to you there, and then Simon in front afterwards.
David Goodman, Bloomberg News. Governor, the report says that the UK may be vulnerable to a reduction in foreign investor appetite for UK assets. Yep. Do you see any evidence that the kindness of strangers is already starting to wane following the Brexit vote?
Well, I would say that, one of the things, and it is detailed in the report, is that the funding of the UK current account deficit has shifted over the course of the last 18 months or so from rundown of UK foreign assets to inflows of foreign capital. So the flows of capital are coming. That's the first point. The second is that there is some evidence of heightened risk premia in the UK. And for example, again, in the report it's detailed the quite marked divergence between equity risk premia for UK-focused assets. So don't think FTSE 100, but think companies that have 3/4 or so of their sales in the UK. The equity risk premium of those assets has gone up, where equity risk premium virtually in every other major financial or equity market has gone down in recent years. We're not seeing it in the gilt market. Obviously, there is sterling is heavily affected by the outlook for or the prospects for Brexit. So it's a mixed story. The UK continues to have tremendous strengths with a degree of uncertainty about the most important driver of medium-term prosperity. I would underscore, though, in terms of maintaining foreign investor interest here, from a Bank of England perspective, our job is to ensure monetary and financial stability in whatever scenarios. And with that bedrock, one can expect that you build off that bedrock to continue to see foreign inflows as we should.
Jack, BBC News. From what I see, from what you said you've looked at a disorderly Brexit and said, is it any worse than the economic stresses we're already putting on the banks? So for that to happen, you need to have compared one against the other. Can you share with us what the economic impact of a disorderly Brexit actually would be?
Well, it's no worse in terms. I mean, I think that's the important point. You can look at the stress scenario here And with respect to actual losses to the banks, it is not a worse scenario. And let me expand on that a bit. First, I think we have to appreciate just how severe the stress test we ran the banks through. 4.7% fall in UK GDP. That's the peak fall in the recession. The level fall is much bigger than that. The level of GDP is 7% plus lower than it would have been in the baseline scenario. And if you take that relative to the spring of 2016, the forecasted spring of 2016, you're approaching something on the order of 10% lower level of GDP 3-4 years out than we had projected prior to the referendum. So, it's a material different track. More than doubling of unemployment to 9.5%, a very sharp increase in bank rate, to go back to David's question a moment ago, occasioned by a much higher risk premium on UK assets. So gilt yields go up sharply, sterling falls by more than 25% above and beyond the fall that we've already experienced. We have to raise bank rate. So it's quite a severe recession and a big hit to, as a consequence to banks. The 50 billion losses they make over the first 2 years of the stress are comparable to the losses they made in the first 2 years of the financial crisis. Now, when we look at a disorderly Brexit, we've had to look at a series of possible things that could happen, as opposed to one just economic scenario. So what we've done as a committee is we've looked at the various challenges we could face if there's no agreement. They start from moving to WTO trade rules, the tariff impacts of that. They can extend to loss of authorization for various products or services, notably financial services, obviously, but other services and products into the EU, which would have a bigger impact than just the tariff impact. They can go to logistical challenges, which we also looked at in terms of not just airlines, but custom challenges. They can extend to some of these cross-cutting issues that we just raised on derivatives, those crystallizing, and so you have risk premia that happen in those markets, and also extend to a loss of financial services in the EU because UK-based entities haven't completed the transition, don't have the authorizations into the EU, and then we get the spillback of those negatives. So we've looked at those aspects and then looked at various combinations of those, and in all cases we end up inside the envelope of what's in the stress test, of the losses that are inside the stress test. So I would use that as an outer bound, and that's where the FPC that's how the FPC came to its judgment. And let's be clear, this is it's a big call because we will be here in March 2019 in the event, in the unlikely event that we end up in a situation without a transition deal, without an agreement. We're putting our money where our mouth is. We have a system, and I'll finish with this. We do have a system that has Tier 1 capital that is 3 times what it was headed into the crisis, where the asset quality is much higher, where the institutions have been consistently stressed against similar events, so events where you don't just have higher unemployment and a recession and therefore asset quality problems because of that, but you have quite extreme moves in sterling and the gilt curve and other asset prices. You have traded risk losses, you have counterparty fails, you have a series of those events happening, and that's what the institutions have been getting ready for. It happens to put them in a better position for Brexit, but it's not this is not a good scenario. It's a scenario we are all working to avoid because it has some quite material economic costs, even if the financial system continues to function through it.
Okay, at the front here, and then Martin.
Andrew McCaskill from Reuters. This is probably best directed to Deputy Governor Sam Woods. To help banks plan for Brexit, one of the things they'll need to know is how they're regulated. So will the branches of EU banks be forced to become subsidiaries?
So we've included a comment in the report today, consistent with what we've been saying publicly, that we will clarify our position on that question by the end of the year. The reason that is an awkward decision for us is at the heart of the decision for us as a regulator, whether you authorise an entity as a branch or a subsidiary, is the level of cooperation and engagement you have with the regulators on the other side. It is plain that the Brexit negotiations are touching on all aspects of the relationship between the UK and the EU27, and therefore it's an unusual situation where that is relevant. We do, though, need to make the position clear because of the sheer volume of applications that we may receive and because of the time that we think it will take to work firms through an authorisation process. And our view is the imperative is to get that out by the end of the year. We've been using this period that we're in currently to to give you a sense of it, there's 160 branches here from the EU, that's 75 banks and 85 insurance companies. We've been getting them all up to speed on what will it take to be authorised either in branch or subsidiary form. So we haven't been sitting on our hands, we've been using that time, but we do intend to move the ball forward before Christmas.
Martin Arnold from the FT. Mark, could you tell us about next year's stress tests and whether you'll specifically model a scenario of a hard Brexit, of a disorderly Brexit? Thanks.
Yeah, Martin, I think the short answer is no, for a couple of reasons. We need to use, by the time of next year, it's a bit late. If we're going to end up with a hard Brexit, I mean, we think the information we need from not just this stress test, but the previous, the 3 years prior, the cross-cutting issues which we've identified, the contingency plans of outbound and inbound firms. So Sam just spoke to inbound firms, and we're working with the institutions. And putting in the public, we're working with the institutions on the specific issues for them, and we're putting in the public domain these, what we call the cross-cutting issues that affect everybody in the financial services. And by the way, one of the cross-cutting issues, which I didn't add to my list, relates to derivatives clearing, a series of issues around derivatives clearing, which is detailed as well in the report, the importance of authorizations there. So Martin, I would put it more in the camp of we're not looking at a theoretical scenario. We're spending time, we're continuing what we've been doing to prepare for that possibility, because I think that's what people expect, both in the financial sector, but more broadly. They'll have lots of things to worry about if we end up in that unhappy event, which is not what we think will happen, but if we end up there, and we've got to use all the time to prepare for it, which is what we're doing.
Okay, we'll have James here at the front and then Harry behind.
Good morning, Governor. James Burton from the Daily Mail. The documents today talk about 30 million European insurance policies being at risk here, and they talk about European businesses being unable to access the interest swaps market in London. So it sounds like a no-deal Brexit would be very disruptive for the European Union as well. Could you sort of give some colour around how disruptive that could be, and say whether or not you think regulators and politicians on the continent realise the risks that they face?
Well, I think, James, that I'll have John expand a bit on this. There is an increased appreciation of these issues on the continent. We, as you would expect, we're in regular dialogue with our colleagues there, whether it's on the insurance side, the banking side, or the central bank. You've seen in recent weeks, actually, some of the banking authorities highlighting more clearly the issues around derivatives. We think it's important to have in the public domain, and we have talked to the insurance authorities there, these issues around insurance. They are solvable issues, but secondary legislation, authorizations, those types of things take time, and they take time at during a period where people are having to do a number of other things related to developing this new relationship. And just before I pass to John, I should underscore that in parallel, I said we're spending all the available time preparing. that's not right. We're spending a substantial proportion of time preparing, but we're spending a lot of time trying to work out what the future cooperative arrangements would be. And apropos of what Sam was saying around authorizations of firms coming in, our predisposition is to expect that we will continue a highly cooperative relationship with Europe. Now, that depends, whether or not that is realized depends, of course, on what agreement is ultimately struck. But we're predisposed to expect that, and we're thinking of different ways to do that, while at the same time, as per your question, James, alerting those authorities to the issues we see that affect them. But John, do you want to?
Yeah, I'll just say a word about clearing. Very high proportion, 80-90% of clearing in euro products and interest rate swaps is done in London. Under current European legislation, European firms can only deal with clearing houses outside the European Union that have been recognised. So if there is no recognition of UK clearing houses, in some cases European banks will just simply not be able to deal with UK clearing houses. In other cases they'll have to hold more capital. So a very large stock of existing contracts, some of them take 30 years to run off. So absent some form of agreement, given that existing contracts have to be maintained, European banks could face large capital charges or just be unable to service their contracts. Those things are solvable. You've seen the Governor's mentioned the reports coming out of some of the European supervisory authorities. Those things are solvable on the European side. I think there's just a growing recognition that they need to be dealt with for the sake of the European counterparties.
Harry Daniels from Live Sport News. Who bears the biggest burden from a disorderly Brexit, the households or the banks, and what would be the reaction function of the FPC or the bank in general to that?
Yeah. Well, what we want is that the banks bear the biggest burden, if you will. Well, it depends on how you define burden. So, a disorderly Brexit would have economic consequences in terms of in the short term, in our view, for growth, slower growth, higher unemployment, higher inflation, lower sterling, higher interest rates, all things being equal. That's the direction. Those are the broad directions. In order that those effects are not amplified, it will be necessary for the banks to draw on some of the capital buffers that they have built up over the course of the past decade. That's why buffers are there. They're there to be used in difficult times. And so in that respect, there's a, quote, burden on the banks, but it's the banks using their capital in order to be in position to satisfy the demand of households and businesses for credit. And so what we want, and we think we put the financial system in a position to do, is that that people who could get mortgages prior to that event could still get mortgages. That if you have a good business idea, you can still get it funded post Brexit because the banks have the wherewithal to do so. And in that regard, we're looking to minimize the impact on households. I want to be clear, though, what that means, though, is that in the event of a sharp, disorderly Brexit, there will be an economic impact on households, on businesses. There will be lost markets for a period of before new markets are found, and there will be some pain associated with that. This is about dampening that, minimizing it, doing what we can in terms of the financial sector. And I just, I think the message from the FPC is that we have been very focused on this alongside with the PRA over time. We've built up these real reserves of strength in the banking system. They're there to be used, and in the event of this unlikely event, they will be used, and that will help the economy adjust as quickly as possible and move forward from that point.
Okay, Paul at the back here, and then Jill.
Hi there, Paul Davis from the Wall Street Journal. A quick non-Brexit question for you. So you've got a nice section on leveraged loans in here. I'm just wondering whether you have concerns about the growth and exposure to private and illiquid assets more broadly, particularly among insurers and pension funds, and how shareholders and policyholders might react in times when those valuations come under questions, valuations of those assets.
Yeah, well, I'll start and then I'll pass to John. In terms of, you're right, there's been a very sharp growth in leveraged loan market outside of the UK, more than into the UK, to the extent to which two of our peers, if you will, as you know, have provided guidance in terms of the overall credit metrics, the debt to EBITDA of 6 times on leveraged loans, and about 2/3 of the leveraged loan market is now subject to such guidance. And also, it happens to be roughly 2/3 of the leveraged loan market is dependent, if you will, or is refinanced through the CLO market, which is broadening the end investor base. In a net positive way, but anytime you see sort of significant developments like that, coupled with quite marked reductions in certainly in covenants, it's effectively totally covenant-light market, which adds to the risk. Anytime you see those types of developments, you get concerned. The net exposure into the UK, at least in the core of the banking system, is quite modest. A tenth or so of total capital, from recollection, is detailed there. But John, do you want to talk about the broader?
Yeah, I think it has been growing in the UK, but UK is still quite a small part of the global market. I think it's about 10% of banks' corporate lending in the UK, and it's about 10% of company financing. And UK companies now are, if you look at their debt to profit, in as good a position as they've been since 1998. It was covered in the stress test. We stressed the leveraged loans in the pipeline, and I think they took nearly a 20% loss rate on that, about 2.5 billion of losses. And corporate lending is stressed very heavily as a whole in the stress test. It's probably about another 50 billions worth of losses in the first couple of years, loss rates going up to just below 10%, I think. So it's been stressed in the stress test. We've looked at it, and the UK banks have come through. None of them have needed to strengthen their capital position. But clearly it's a fast developing market, and it's a thing that we watch, but we haven't seen the need yet to follow either the US or the EU authorities.
Okay, Jill, back here then.
Hi, I had Jill Trino from The Guardian. I had a quick question about the mortgage market. In the Financial Stability Review, you talk about continued easing in price and non-price terms in the mortgage market, and that this could increase the number of vulnerable households in the event of rate rises and other situations. I wondered if you're concerned about what's going on in the mortgage market now.
Yeah, well, let me start. The FPC has put in place over the course of the last few years several protections in the mortgage market, and the first is a portfolio flow restriction. So the proportion of high loan-to-income mortgages that banks and building societies can underwrite is restricted to 15% of new mortgages. And what we're seeing is that the actual numbers are around 10%. So we have a restriction. The institutions are quite inside that. There is a bit of a bunching in the 4 to 4.5 range, which we're watching. But overall, we have structured that, and we think it's working quite well. We've structured it in a way that it provides enough room for first-time buyers, people in higher valued markets to get into the market, but not to have a broader deterioration in underwriting standards as a consequence. The second thing is that we have institution stress for owner-occupied mortgages at a 300 basis point, a 3% rate above the so-called reversion rate. So we're helping to ensure that once people come off the fixed-price deals that they're able, in a more difficult economic environment, if that's the case, that they're able to continue to service their debts, and that also is working well. I think the interesting thing that comes out of the stress test is where we've had slightly greater concern has been around buy-to-let and the underwriting standards there. We've also put some protections in on that. It's detailed in the pages in there, but the losses on buy-to-let are a multiple. In fact, they're 4.5 times the losses on owner-occupied mortgages in this stress. And if you look at last year's stress test, which had a different rate environment, different scenarios, it was about 2.5 times. That gives us a bit of a sense in terms of the relative riskiness here. So just to sort of summarize, when we look at the mortgage markets, obviously the biggest thing on most banks' balance sheets, it's clearly far and away for most people who are fortunate enough to own a home, it's their biggest liability. British people pay their mortgage, pay off their mortgage, so the risk to banks of these mortgages is actually not that high. The protections we put in place in terms of underwriting standards seem to be effective, as we would expect them to be. And as a consequence, people who are coming into the mortgage market are not getting themselves in a position where they're overextended in general, even against adverse environments. I don't know, Sam, if you want to.
Maybe just add a tiny bit. There are a couple of useful things in the report to give some colour to that. So we look at it through the effect on the banks. How big would the impact be of these things going wrong? And I think it's quite striking that the impairment rate that we have for mortgages across 5 years is 1.7%. So that is roughly 17 billion of losses out of 70 billion total that we think the UK banks would make in gross losses on UK lending. Compares, for instance, to a 5-year impairment rate of 28% for consumer credit. So that gives you 29 billion, even though that is only 7% of lending. So I think the effect of all the various things that we have been doing, which has been designed to avoid a disproportionately high tail of highly indebted households who could cause the banks severe losses, as well as impact the economy more directly through their reduced spending, that we are seeing the effect of that in this test with that level of impairments, despite the fact that rates are going up to 4% and unemployment is going up to 9.5%.
Okay, at the front here, and then Ian at the back there.
Anna Stewart, CNN. Mr. Carney, are banks too confident or complacent that they'll be able to use mechanisms like back-to-back trading and reverse solicitation to do business in the EU after Brexit? What's your advice to them?
I think first off, the ability of banks to employ those strategies is not solely in our gift, so let's go specifically to back-to-back structures. If an institution has opened up a new subsidiary somewhere on the continent and is putting the risk back into the London-based entity, where the capital and the collateral and the people and the risk managers are, that might be a sensible, expedient, short-term strategy, but it's unlikely to be a sustainable strategy, unless we have what we would recommend, unless we have a negotiated agreement that permits wholesale activity cross-border, a continued access for certain wholesale activities. So it's a strategy that's very much dependent on the final deal. And in the event of, if I can use this term, in the event of a very narrow agreement for financial services, it's unlikely to be a sustainable equilibrium. And that's, it's part of the reason why, and there's various estimates, and would rather not be pinned down on any precise one in the short and medium term, but it's why there's quite a difference in terms of people's estimates of how many jobs or assets would move in the short term versus, let's say, 5 years out, because those types of strategies will tend to be will tend to be less sustainable.
Okay, Ian.
Hi, Ian Withers from The Telegraph. You said you might need to increase capital requirements again next year. Can you just comment on how the level of risk to the financial system compares historically? And also, do you think investors will have to get used to low or no dividends in the future? Thank you.
There's two questions in that. I'll let Sam advise the banks on dividend policy. And in terms of the FPC's potential reconsideration of the CCYB the countercyclical buffer next year. Let me say first on the risk environment. We view the overall risk environment apart from Brexit as being standard. And so there are pockets of risks. Consumer credit is a pocket of risk. It's been growing quite rapidly. It accounts for, as Sam just referenced, greater impairments in the stress test than the mortgage books, which are substantially bigger, almost 7 times bigger. So there's a pocket of risk there. But in general, overall credit growth is roughly, it's a little higher than nominal GDP, but not much. The levels of debt service, households that have high debt service, very low relative to historic averages. The same for corporates. Again, both are detailed in the reports, but would take quite substantial increases in the overall level of interest rates before they even got back to historic averages. Nothing like what's projected in the market for passive interest rates. So the overall risk-taking environment is standard, apart from Brexit. We've made the separate judgment in terms of Brexit relative to the stress test. The consideration of the FPC has to consider actually by law every quarter whether or not the countercyclical buffer is at the right level. So we always will be reconsidering. The reason we flagged a reconsideration in the new year is that in our judgment, as we've said, the banks are resilient to a disorderly Brexit. The question is, what if something else is likely to happen at the same time? And that's what we mean by evolution of the risk environment. As we get into 2018, we have to assess risks globally, risks in terms of misconduct costs, risks in terms of elevated asset prices, and make a judgment about what's the joint probability. We've got, if you will, we have Brexit covered. What about these other issues, and is it possible that they may crystallize in the relatively near term? You can make your own judgment about how likely that would be, but we will definitely do the reassessment.
Okay, just next door, and then Catherine.
Hi, Jasper Jolly from City AM. Do you think that banks are being too complacent faced with the long-term fintech challenges, thinking that they can cut costs while preserving market share?
Well, I think that's the challenge to them. What's interesting in the stress test, not stress test, this exploratory scenario, which is detailed in the stress test document, is we asked them 2 questions. Now, some respects, we sent them a tough exam question. One was, what if interest rates stay low? We stay in a low interest rate, low growth environment. How are you going to manage that? How are you going to? What do you think your hurdle? What do you think investors are going to demand of you in terms of return on equity, and how are you going to exceed that? And also, by the way, to your question, be aware that there are these bigger developments going on in new financial technologies and potential competitive environment. And in some respects, they took the good from financial technology and said that will help drive down their costs and meet a lower return on equity hurdle rate than they currently have, than they're currently targeting, because their assumption is that in a lower growth environment, investor expectations will be lower for their returns. And our observation on that, it's not saying it's wrong, but our observations are twofold. One is to say it's not necessarily the case that if we collectively, if the global economy is stuck in a low growth environment or the UK economy is in a low growth environment, that investor expectations for return on equity will be lower. Because if you have an expectation as an investor that something bad may happen as well, that being in a low growth environment makes a bad outcome more likely, you actually have a higher return on equity objective because you're insulating against that. And also if the environment as a whole is more uncertain, the hurdle rate goes up. You just simple option pricing will tell you that. So it's not clear that just because it's low growth, it's a low return on equity that is expected. And that's part of the problem with being in a low growth environment, is you can potentially get in this trap, if you will, that's self-reinforcing. That's the first point. The second, and you can take both sides of that argument, but it at least bears consideration. The second point, directly to your question around fintech, is that the basic assumption of the banks is that the cost of acquiring new customers or keeping their existing customers goes down because of the application of these technologies. And it's detailed a bit in the report, is that actually from consumer perspective, this environment is potentially a pretty exciting environment, because it's open banking, which starts next year, is going to mean that it's going to be a lot easier for me to switch my accounts from one financial services provider to another. There's a series of other developments which will reinforce that. And it's possible that at least some banks will become not front-facing to the customer, but more utilities behind the customer, that the customer, if you will be serviced, or the core relationship will be by a non-bank that effectively plays off banks against each other for the provision of deposit or lending services. That's from our perspective. We're not looking to protect the banks here. From our perspective, that's fine, but the banks may need a different capital, liquidity, and cost structure in that environment. It may be more costly to keep people. The liquidity aspects may be more volatile. People may jump in and out of different institutions, all to the benefit of the end consumer, but that changes the structure, and that's the conversation, and those are some of the strategic considerations that some of the institutions might want to think through a little more generally. Did you want to add something to that?
In the stress, we gave them some assumptions about what would happen to income from interest rates because of more competition, but there are other areas like the ability to cross-sell, like the need to retain liquidity, like the possibility of cyber, which might just put up the cost of this, which also in the round need to be taken into account. And those are things they're going to have to think about, I think, going forward.
Catherine Griffiths from The Times. Apologies, a very small diversion from stress testing. Given the importance of the London Stock Exchange to the city, how concerned are you about the events there at the moment, the disagreements within its board? Thanks.
Let me say this, which is that we obviously take an interest in this. The clearing operations of London Stock Exchange Group are. This is systemic infrastructure, and it's incredibly important to not just UK, not just European, but to global derivative markets, and the stock exchange plays obviously an incredibly important role. I think Xavier Rollet, the CEO of the LSE, has made an extraordinary contribution over the course of the last 9 years, I guess, as CEO. Everything comes to an end. We were apprised of the succession plan before it was announced, the agreed succession plan before it was announced. We've stayed close to the situation. I'm a bit, in some respects, I'm a bit mystified by the debate because we knew about the succession plan. We've stayed close to the situation. I can't envision a circumstance where the CEO stays on beyond the agreed period, and so I think it's in the interests of all parties involved that clarity is provided as soon as possible.
Okay, just in front and then next door as well, please.
Hi, Max Colchester from the Wall Street Journal. A question about international banks and their exposure to the UK financial system. Have you seen evidence of them cutting their exposure in the lead up to Brexit? And can you quantify this in any way?
Do you want to speak to the EBA stuff? Yeah.
I mean, if you're referring to what we saw in the EBA report that came out a few days ago, we're looking at the EBA numbers, but we haven't seen a large impact of that sort. And I'd say, just going back to that earlier question on the capital account, what we have seen since the beginning of 2016 is fairly substantial flows into the UK. The bulk of that's been foreign direct investment. I think about £375 billion, but it's been across the board. So we'll have to have a look at what the EBA have identified. But generally speaking, I mean, we haven't identified something of that nature. A lot of it might just be to do with derivatives contracts, and some of it might be to do with valuation effects, which you would expect because of the depreciation of sterling. They will have changed the numbers.
Yeah, that's right.
Kat Contiglia from Politico. I have a question for Mr. Woods. You said in testimony to lawmakers that the best way to frame a post-Brexit deal in financial services would be in a trade deal. How realistic do you think that outcome is?
Well, I want to echo what Mark said earlier, which is I don't think it's our job to make a central projection of where the Brexit negotiations are going to get to. It's our job to think about how do we make sure the financial system is robust to an outcome in which our preferred objective, which is the one that you described, is not achieved. And that's, I think, the significance of what we're saying today, that in our assessment, the severity of the scenario through which we put the banks for the purposes of the ACS is outside what we could reasonably expect to be the severity of a scenario which might result from a disorderly Brexit, including not being able to achieve an FTA of the kind that you described. So our focus is there. We, of course, hope that such an agreement can be reached, and we hope very strongly that an agreement on a transitional can be reached. But I think it's our job to worry about the downside and protect the UK financial system against the downside.
Can I just supplement that and link it to the previous question about back-to-back and those exposures? The nature of what Sam and his colleagues do at the PRA is to manage, oversee basically the most complex bit of the global financial system. And with respect to Europe, and then alongside with John on the financial market infrastructure side, with respect to Europe, the most tightly intertwined bit of the most complex bit of the financial system. It is a ecosystem that's in place that underwrites more than half the debt, that does all the derivative transactions in effect for Europe, underwrites half the equity that is absolutely integral to the financing of the European Union. And it is absolutely in the interests of all parties, but very much in the interests of Europe, that elements of that degree of close cooperation are maintained following Brexit. Now, there are lots of different models to do that. It's entirely in the hands of those who are negotiating the agreement, and we and our European colleagues will sort of faithfully implement whatever is agreed. But I think we should underscore that, because quite rightly we're focused today on making sure we're prepared for the tail event of no agreement, no transition. We should underscore how undesirable that is for everybody concerned, and how the posture of this institution and its constituent parts is very much towards finding solutions where the political masters decree, finding solutions to maintain that system, which serves both sides of the channel extremely well.
Okay, and I think we've got time for one last question.
Alex, question for Sam Wood. The decision on the authorization of EU banks, can it have an impact on the branches of third country banks that are already in the UK. So US banks, Japanese banks that are operating through branches, will they be affected?
So there are two ways of thinking about that question. One is, do we expect a change in our stance towards the existing operations of third country banks here in the UK, or a change of a kind that could require changes to how they operate? And I would encourage you to think of the probability of that as low. But the other way to think about it is there a possibility that in reaction to Brexit of one shape or another, the financial system which Mark was describing, which we oversee, reshapes itself across the border, including third country banks reshaping themselves across the border? And are there ways that that reshaping could occur which might present some risks to our objective, and we might therefore need to be clear about how we would react to such changes? Then that is more probable.
Okay, I think that brings us to the end of the press conference. Thank you very much, ladies and gentlemen.
Thank you.